Let's start off with how you see today shaping up. We just mentioned some of the pressure on the NASDAQ yesterday. How do you see today shaping up? What's your WEX word of the day?
So today is shaping up, I think, as we would expect, as we're trying to sort out all these cross currents, right? And so we don't know if this rotation we're seeing is going to be permanent. We're trying to work that out. We're trying to work, falling rates is usually dollar negative. We're trying to work that out. We're trying to work out if protectionist policies being espoused by the presumed winner of the election is starting to take hold as well, which would be bad for companies that generate revenue overseas, but good for small caps, which generate a much smaller percentage of their revenue overseas. So we're going to be mixed today. We're going to be mixed for a while because there just aren't any catalysts right now, Frank.
You went to mix? Okay, that's interesting because, Greg, you're known to be a bear. You could have easily thrown something bearish in there after the tech sell-off yesterday. So I want to ask you, how do you view it? I've been talking to a lot of traders. A lot of them believe that some of this rotation out of mega cap tech and things, it's going to kind of change next week as we get mega cap tech earnings.
Yeah, it might. The net is that we're going to have a great earnings quarter. Right now we're at 9%. As the quarter seasons, it's likely to get to 12, 13%, which is going to be the highest growth rate we've seen in over 2 years. And tech's going to lead. Communication services will probably put up 20%. That'll largely be driven by Alphabet and Meta. Information services will largely be driven by NVIDIA, and we'll probably see 17 to 18% there. So earnings will support the current leadership. But the whole quarter overall is going to be great. And so I don't know.
Wait, Greg. The whole quarter is going to be great?
I'm not a perma-bear, Frank.
Okay.
It's data-driven. My opinions are always data-driven.
I'm just giving you a hard time. I do want to lean back on the rotation a bit. Before yesterday's session, we saw 5 days of gains for small caps and also the transports. How do you view that? All year long, we've heard people saying small caps are going to rally, but it's based on two things, getting Fed cuts and the economy staying strong. Do you believe small caps are one of the better places to put money in that basically soft landing scenario, or do you see other areas as a better opportunity?
So in order to see it as a safe scenario, you kind of have to look through what we have to go through and the reason that the Fed's going to cut, which is the environment's going to become more hazardous. So yes, a Fed rate cut solves a balance sheet problem in that it abates the risk of financial duress, but it creates a revenue problem. Because what it also does is it means that demand's going to soften as a result of the 500 basis points we've already seen put up. You don't get one in terms of declining inflation without the revenue hazard. That's how we get the declining inflation. So we're sorting through this. And the key word of the day is versatility. What we're looking for now are things that tie in to our old themes, structural supply-demand imbalance, generational secular tailwinds, but where we can also get some international exposure, such as shipping, for example, where rates are 5 times where they were last year. The top 30 container shippers, there's only one American company, which is Matson, and you can play it by Zim, which is also small cap. Your small cap exposure there, we look for some of these miners.
Yeah, you gave us 2 picks in the shipping space. By the way, that's kind of my wheelhouse. So I do want to ask you, we're going to show the chart. I'm looking at Maersk. That was one of your picks. Third quarter down more than 7%. Zim Integrated Shipping, another one of your picks, down about 19%. I agree with you. Container shipping prices are going up, but investors seem to be selling off on these names because global demand for consumer goods and things like that is lower. So why would you want to invest in these names now as we see consumers under pressure here in the U.S. and also in other parts of the world? Because
there's another vector that will simply overpower that. When you have rates that are 5 times where they were last year, you're going to see impressive earnings growth in the second quarter, third quarter, and throughout all of 2025. They simply can't build the capacity to come online soon enough, and we have to unwind all these secondary stops around the Red Sea where we're having congestion, which is obviously lengthening shipping times and creates a capacity glut as well.